The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and or through separate funds and may change their holdings at any time.
Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome to a new episode of This Week in Intelligent Investing. Great to have you with us. We have a special episode ahead with a special guest, Mario Cibelli. I think all of you listening will enjoy it. It's going to be timely, also timeless, I think, in a lot of ways. So, Elliot, why don't I have you introduce Mario and set the stage for our discussion?
Great. Thanks, John. And thanks, Mario, for joining. I'm excited to have Mario on for his second appearance on This Week in Intelligent Investing. We had been having some conversations offline about what's been happening in the market lately. And I thought it would be really helpful to record some of these topics that we've touched on. Mario has been a mentor to me and has immense experience navigating, especially in the small and mid-cap space, through some pretty choppy environments, much like we're experiencing right now. And I thought, like John said, there could be some timeless wisdom that's imparted through this all. And I thought it would be helpful for everyone else to get a lens into Mario's thinking. So thank you for joining and looking forward to this.
Thanks for having me.
Yeah, my pleasure. So to start, maybe talk about the environment in general. And like when you think back on your past experiences, what you think it's most comparable to?
Yeah, I've been, reaching back to the kind of 1998, 2000 through 2003 time period. And I do feel that we've, the current market dynamics are very much reminding me of that period, which was, I think a pretty fruitful one for, for stock picking. But I guess this week, over the past week, I did a little tweet storm about it. Kind of essentially, companies should start assuming, and therefore the investors in these companies, and growth companies are ground zero for the weakness in the market here. The reinforcements aren't coming. There's no fast rescue plan. Companies are going to have to figure out a way to help themselves. The faster they figure that out, the faster they realize that, the better off, all the stakeholders will be. So, I guess if we were flowing the conversation from there to start, that would be, the first observation I made. To some extent, what happened, after the dot-com crash, where, and I'm generalizing a bit. In 1998, I'd say there was a, small cap value implosion that created a lot of great opportunities. After the dot-com crash, I would say small caps in general across value and growth got very interesting. But essentially, there was a vast oversupply of small cap companies available for sale, kind of post Q1 2000. And I went back and looked in detail, and that really lasted for 3 quarters in 2000, all 4 quarters in 2001, and then 3 quarters in 2004. And I distinctly remember now, in Q4 of 2002, you again were chasing shares. The supply demand had come into balance. A number of factors over the prior period had sopped up a lot of the excess supply of these shares. You had crossover buyers come in. You had strategic M&A. You had management buyouts. You had insider buys, share repurchases. You had activists target these companies. And then again, it lasted for some period of time. But by the fourth quarter of 2002 and first quarter of 2003, you were kind of chasing shares again, and flows had reversed, and it created a multi-year kind of tailwind, and the opportunity was largely gone. This period reminds me of that, and I would say, this period is really characterized by, absolute destruction in the bid for growth equities, small and mid, and I think we're in the process of sorting that out once again, and it will take some time. But I'd say it's naive to think, and companies certainly shouldn't be preparing for, a quick reemergence of a bid for growth equities. That they should start planning accordingly. That this may last for some time, and what, if anything, can they do in the meantime to improve shareholders' relative positioning so they emerge stronger? And can they do things that lessen the time to break even, enhance profitability, repurchase shares at more shares at a very opportunistic price, not just offsetting, say, stock-based compensation? I do think we're in a period like that, and management teams need to pay attention. And now I have floated this to multiple companies in our portfolio and discussed it, and I do think companies are beginning to get on board, beginning to understand that again, there's no rescue boats coming. You know what? They're going to have to get to shore themselves. They're going to have to figure out how to do it on their own.
Yeah, no, that's a really interesting point, because for the last 5 years, basically, maybe even more, some would say, growth was rewarded to invest in growth. And a lot of companies were, and investors alike were pointing to, hey, Amazon built this immense scale, having never made a profit, so we're going to do the same thing. And you mentioned this like supply-demand dynamic that happened in 98, 2000, and again, probably more recently, where you had a lot of these SPACs and a lot of equities coming to market. And effectively, there were clearly some companies hiding who were not necessarily good on the unit economic basis, hiding the fact that they were kind of crummy companies that were saying, we invest in growth, buy us. But how do you separate the baby from the bathwater, and how do you get management teams to start listening to this idea that the market environment has changed and they should start thinking a little differently about what to do from here?
Well, separating the baby from the bathwater, that's what you and I and everyone else gets paid for. So you still have to find quality companies. There's plenty of growth companies that are still overvalued in this market. And as a general rule, I would tend to stay away from SPACs. You're looking for seasoned companies that have been through the ringer, that are beat up, that have potentially still great and wonderful prospects. The overvalued SPAC that put out faulty projections, that is brand new entrant to the public markets. I'm tend to be less interested in those kinds of things. So I'm assuming that you're able to discern between quality and lack of quality in these kinds of businesses. For starters, what was the second part of the question you asked, or what did you say? You said something.
So the second part was really the broader part, which is like companies have been trained to invest in growth for these last few years, and that's what they were rewarded for. So like the good companies who'd done that and had been rewarded accordingly are facing some pains right now. So how do you get them to open their mind to changing what had been working for the last half decade to maybe even decade in some cases?
Yeah, that it gets down to your relationship with the management team, what kind of temperament you have. Look, I talked to a company today, and my words of wisdom were, run the activist playbook before they run it for you. That's a very good cure for keeping an activist away, to kind of do things that make sense for the shareholders. This is a time where difficult decisions have to be made. I look across many companies in my portfolio, and some have very difficult decisions to be made that would enhance value. Some less so. Some would have opportunities to enhance value or do something differently. The idea, oh, hey, here's the subsidiary. We need to own 100% of it. We acquired it a few years ago. You don't need to own 100% of it. Maybe you should merge that with another business and take a stake back. And that combined business is way more valuable than the two of these other businesses competing separately. You don't have to own 100% of that. Everything kind of needs to be on the table here. Granted, if you have two classes of shares, you could really ignore the shareholders and do it exactly what you want. But even there's a price to pay, because if a two-class share structure gets the reputation that this team and board really doesn't care about the shareholders, well, how do you think that what's the bid for that equity going to be in this market? It's not going to be that much. Then when it comes to attracting and retaining talent, it just got that much harder, and the dilution that the controlled shareholders would have to suffer to hire new talent is more than it would otherwise. So it's like, ignore that at your own peril. So even control situations, that have, a dramatically different equity cost of capital, well, there's a price to pay. So I would say, the companies need help. Have the conversations, talk to them about it, make suggestions. And, if a team is burying their head in the sand on ideas for enhancing value and accelerating value, then maybe there's a better management team. Maybe someone else should be given the ball here. You don't go through this kind of correction, with a bunch of growth investors with no, ramifications, right? That's the thing. You look at the valuation, the stocks are down. Yes, there's reactions. A lot of growth investors, on one of them, have been getting their teeth kicked in. It's painful. I want the management teams to respond to this new environment. It's not an unreasonable thing. I'm not asking for them to do stupid things. I'm not asking them to react to every tick in the marketplace. But if I can get a management team to agree that this is probably the environment that's going to be around for a little bit. If they agree to that, then let's start talking about what we can do to potentially enhance the value, to pull value forward. Do you want a management team here saying, hey, the environment hasn't changed really. We're going all in and accelerating the losses in this one division. And, the profit pool is pretty distant, but it's going to be a big profit pool. Good luck with that. That may not go over so well with your shareholders. So I do think, for me personally, we're long-term investors, but are we looking harder at our portfolio companies, saying, well, what could we do in the interim to improve our positioning? And if you have no answers for that, and you're being provided some really good ideas, and none of them make any sense to that team, again, then I would question, well, what's your objective, Mr. Mr. CEO and Mr. Board member? What's your objective here? So you got to you got to turn on the charm, Elliot. Smile a little bit, make some friends, and then I don't know, no response whatsoever. Maybe some activist shows up at your door with some ideas that will appeal to the shareholders.
Yeah, no, it's really interesting. You mentioned a few good tools, and it's something to reflect on how, when things are going well, a lot of companies, especially, I'm a smaller investor in the grand scheme of things, don't have that much scale that when I ask for a call, I get the call per se. But and I think it's not just me, but some medium and larger sized companies who are growthier in name and not in a great place right now, had been thumbing their nose up at investors and not necessarily talking as enthusiastically or as openly, nor disclosing exactly what they should be to paint the right picture about their business. And you mentioned something about increased disclosure. So you think companies are going to start doing that on their own, or do you think it takes a little pressure? How do you think that changes the playing field for people out there?
Well, I think you're trying to get me to talk about a specific company when you say disclosures, and I'll talk a little bit. Which
I'm talking more generally, because I think I could name maybe a dozen companies that fit that bill right now.
Okay, we won't name a big cap fintech player that probably should have better disclosure, and I think is working on better disclosure. Okay, we'll leave that one, put that one aside for now. Look, I think. This is every company is unique. Every situation is different. With certain companies, I think way more disclosure is called for. and makes sense and is a fair way to treat investors. Investors ultimately want to feel as if they're true partners in the business. And if your disclosures are such that they don't feel that way, well, that's not a good dynamic. Other companies they're more concrete things. This should be done. That should be done. Why aren't we managing expenses better? How come margins haven't gone up in the past 2 years? You're giving me, pro forma earnings. Well, stock-based compensation is a real expense. How come we're not leveraging that line? So every company is something different. Some companies, clearly have, there's clear moves that have nothing to do with disclosure that they should do to enhance value. Share repurchases. I've had that conversation with a number of companies. It's hard to say. I would say actually, my opinion is that additional disclosure is kind of that's not the average conversation that I'm having with people. It's really more about actions rather than disclosure. But certainly, I have some companies where that they have not done a wonderful job of sharing information with the owners. And yeah, you're right. When you share, when your share price is going up and to the right, there tends to be some complacency on both sides, management boards, and the shareholders, and that's kind of quickly evaporated here, especially for growth companies.
Yeah, and beyond that, you spoke about some other things. I've been trying to break down the universe of growthier stocks and my portfolio and things on the outside looking in into effectively three kinds of situations. Those companies who have an opportunity to go from having invested full throttle into growth and actually show margin today. So where you could get rising profitability very quickly in the near term, maybe midterm. So that's bucket one. Bucket two, those companies who are in position to meaningfully shrink their share count, where they've had, maybe not quite an optimized balance sheet, a lot of cash, good cash flow already, and the capacity to, even well beyond kind of keeping share count flat ex SBC to actually take out shares very quickly. And then the third are those companies who are in position where a falling share price makes themselves vulnerable to the M&A environment, where even with a dual share class structure, they might become someone that gets sought after in a different way. How do you think about each of those three things and what's going on now? And how should that play out from here, looking for companies to do some of those things? I know the third bucket companies can't do, but the acquirers. Do you think the acquirers out there are sitting ready to act, or you think that's part of what takes some more time to play out here?
Well, the reaction time is not instantaneous, and I suppose you could put, M&A is probably the last thing that happens. Share repurchases can happen faster. That kind of internal things that could happen would tend to happen faster. Disclosure, could come, relatively quickly. But I think those buckets are all valid. I don't necessarily have those. I haven't really thought about it on which bucket do these things fall into. But I would say this growth correction, it's kind of been sneaking up since July, and then December got it was a tough period, and I would have. My expectations were that that the things that were kind of most beat up last year might see a little bit of a bid this year. That turned out to be completely wrong. So I think it's set in. It's starting to set in that this is the environment. It is not. It is going to be here for a while. We have to learn how to live here. It's a little bit different than we've experienced before. But if some other company makes the transition faster, and it's competing with you and gets a better valuation, that's the whole competitive thing. And maybe they're going to bid for you. Maybe you're going to be taken out. There should be advantages that accrue to companies that figure out this faster than others. And there's always a buy versus build decision, that larger companies would contemplate. It certainly happened back in 2000 and 2003. 100%. Why? A rational management team is not only going to build things, it has to consider buying them along with building. To not do so would be irrational. And so you 100%, you have some very strategic, very interesting platforms and assets sitting out here right now, with not a whole lot of interest in it. And someone could always say, oh, well, look, the PE is pretty high, or they don't have any earnings yet. Yeah, but there's some companies that are going to have a high level of future earnings. No one's paying for those earnings right now. I mean, we have a whole generation of growth investors that are unlearning to pay for things, and that's good. That there needs to be some balance restored, but not every company has to earn a lot of money to be sitting on top of a very super strategic, interesting platform. So I absolutely think through a variety of mechanisms that this vast oversupply of growth shares that are floating around the street now, that's going to get sopped up. It will. It 100% will. I don't know how long it'll take. And certainly some of them are very compelling longs, and plenty of them are crap companies that aren't going to get much done. But yeah, I think that the clock's ticking. There will be moves, and I don't think we have to wait forever to see them. Now, some stability in the capital markets, is a plus when it comes to M&A and LBOs. So we need some stability there for things to occur. But yeah, 100%. That was one of the mechanisms that kind of stopped up all those shares that were in oversupply in 2000 through 2002, and it will be one of the mechanisms this time. It's kind of this weird dynamic. I mean, you could, oh, that's a huge premium. Look how big that premium is. Like, oh, that's not a huge premium. That's the September price. Huge premium, but that's a September price. We're in that dynamic now, and management teams are, some of them are going to make moves. 100%.
Yeah, that's been one of the crazy things for me about this environment, seeing how everything's become one trade. And I think one of the important points that you've impressed on me through this is how, before companies didn't really have to do anything, but now companies could take some of their fate in their own hands and could do some of these actions. Like you said, preempt the activist playbook, where when things are going well, they just don't have to think about that sort of stuff. But now, this comes into critical questions, especially for growth companies who still need to hire to achieve their ambitions, who still need to keep their employees happy and prevent atrophy. That it's not just about shareholders as well. It's about, achieving their core business objectives. And there's a reflexivity involved that'll inspire action. So they're more amenable and more open to thinking about what to do, like the right companies are in this environment. And I've found that to be a very interesting point.
Yeah, I've had 3 or 4 conversations, and I'm going to be having more on this. And generally speaking, they're going pretty well. And I think I've had universal agreement that that this is the new environment. Our job is to create value for shareholders. This is the new environment. We have to figure out, effective ways of doing that. And that flows right to us with the funds we manage for investors. People are expecting companies to figure out a way to survive and thrive. Even though the environment's tough, and I think that there are more tools to do that than before. With the valuations becoming wrecked. Essentially our job's the same. You want to create value, and you want to create more value than the next guy, next person, I should say. And if everyone's going down 50% and you come down 25%, and then on the ups, you're kind of beating on the ups. Well, you've done a really good job in a tough environment. So companies are going to have to sort through this, and their relationship with their shareholders, and how they interact with the capital markets, is very important. We have just had a fairly dramatic repricing of equity capital across a lot of companies, right? That can't be ignored. We have to think about it. It's like if you had a mortgage, if you have a mortgage on your house, your mortgage repriced by 40%, are you going to do nothing? It's nothing at all, really? Maybe you don't take that vacation. Maybe you cut that expense out. Maybe you do something different, so you kind of have your nut covered. So, I mean, this is a fairly big thing, and the companies that get there first, and shareholders should try to help them along the way. It's just going to be better for everyone that way. There's not enough life jackets, on the boat for everyone. So it's time to make some tough calls at companies. They really have to do it, and they ought to be doing it and thinking about it when they have more control of the situation. I think that is much preferable to someone coming in over the top and critiquing them. Look, you could have two classes of shares and have full control of the company, but you could have critics, and it just doesn't serve anyone well. So I do think this cuts across single class and dual class shares. If the dual class companies feel strongly about doing a good job for shareholders, they'll act as if they had a single class of shares, and that remains to be seen who will act that way and who doesn't. But there's a price to pay. There's a price to pay if you bury your head and you pretend your cost of equity capital hasn't moved here at all.
Yeah, that's a huge point. I think one of the things that's interesting is I can't remember which company. We already did see one company collapse their A and B shares. You think that's going to be something that happens more with some of these companies where they'll be proactive? And do you think any of them, I mean, I've seen at least one company who has founder control, but they still seem to be acting on the activist playbook. Do you think some of them just start wanting to listen to this organically?
Yeah, a lot of the dual classes more recently, have automatic sunset provisions after 10 years, or maybe if the B shares become a certain and lower percentage of the overall shares, that there's an automatic conversion. I think those things are reasonable. They're pretty good. The permanent structures of dual class, I tend not to like as much, though. Quite honestly, some of those structures are in the hands of very trustworthy and honest people that do a good job with it. But I think over very long periods of time, dual permanent class is not really an optimal situation. So, I guess I wouldn't make a prediction that the dual classes will, on purpose collapse. And I guess I brought it up more just to say that if a company with a dual class of shares and a cheap equity thinks it's safe because it really doesn't have to answer to shareholders, all I'm simply saying is that there are other prices to pay. And if you have the ignored equity, it comes to bite you in the butt in other ways. So to some extent, even the duals have to pay attention to their share price. And in an idealistic world, they're acting as if they don't have a dual share class. That's a little bit unnatural, but I think some people do that and get that.
Maybe Mario, I can jump in just with a thought or a question on companies that are self-funding in terms of their growth plans versus others that'll have to go back to the markets. I feel like maybe a clear distinction should be drawn there, because let's say you're a company that's going to be able to self-fund the growth plan, and you've had a plan in place for the last couple of years. Does it make sense to really give the market so much credit and say, well, the market's right that now all of these comps are worth half of what they were 6 months ago, so we should pull back on the growth spend? I mean, if the numbers bear it out, why not just keep executing the plan?
Well, again, every situation for every company is a little bit different. I mean, look, Amazon's put up, show me quarters. We're like, yeah, we could show leverage if we want. We'd prefer to keep growing, but they've done that from time to time. And if Amazon does that from time to time, then other companies might consider doing that from time to time, especially smaller or medium-sized company. And again, every situation is different, and so it could make sense with certain companies that there's a very limited reaction to the new cost of equity capital. With other ones that might be less true. So if look, if a company is reliant on outside financing to get to its business model, like, they should be paying pretty close attention here. And I'll look, and then you have these crossover kind of funds where they might take a convertible preferred at an opportunistic time with some board seats and that, and that's dilution for the common shareholders. So in a situation where capital is needed, maybe there's a strategic or semi-strategic or a branded financial partner that can come in and lend stability, get on board. There's some dilution there, and maybe they get a yield that the common shareholders don't. But some of those transactions, might make sense. Better yet might be companies that are perceived to need outside financing, but get much more competitive. They need less of it, or they make their runway longer than people expected. Those are value enhancing things. So they make tough decisions, they make tough calls, and they find out a way to extend their runway before they need that capital, or even eliminate it by getting rid of some division or doing something that was kind of a sidebar for them. You don't want to be a conglomerate in this market, and we actually own a couple conglomerates, I'd say, because they're being heavily discounted in this marketplace. And I would look at them and say, well, maybe that one division, maybe that shouldn't be there anymore. Maybe that should be spun off. Or your share price is so low, I don't really care about that division at all. Make it go away, sell it. And those are, you could change the trajectory here on time to raise pretty dramatically. And those are big, important decisions. I think some companies are going to get that sooner than others. And then, the CEO that has to own 100% of this business or 100% of the whole thing, it could be that a trade makes sense, a combination. And one CEO is going to lose their job, but a combination to make a stronger competitor that's competing against some incumbents. Like, who wants to hear about ego in this environment? Put your ego aside. You have a lot of overhead. Collapse the overhead, put these two together, and I got a really interesting company now that can go out and compete against some incumbents. Now I own less of that business than I did before, but I have a better business. Why not? All these things should be on the table, and that's why I continue to emphasize every single company is different here. I don't have one set of recommendations, for all the companies, other than recognize the rules have changed, adjust to the new realities of the marketplace, and then lastly, most importantly, get back, refocus on the number one objective to shareholders, creating value for them. I don't necessarily care how you do it, or if you dilute me in an intelligent manner, or I end up owning shares of another company. Create value for me. That's your job. That's what you're paid for. You're not just paid to expand your organization so you can hand out more stock-based comp to employees and have reign over a larger organization. All these things need to be on the table. They really do.
Yeah, interesting. So we've talked a lot about what companies should do. Maybe we should talk a little bit about the role of the portfolio manager, right? So everything's been one trade in this market. There are lots of beaten down names. I'm curious, how do you think about something like, do you broaden your aperture and increase the number of names in your book? Or do you shrink it and focus on a few where there could be a difference? Like, how do you think about diversification right now?
Yeah, we're definitely broadening because, I think I can own multiple things that kind of have the same upside. If I have 5 things, with roughly the same upside as the one thing, that diversification makes all the sense in the world. So yeah, that we, our portfolio is adding more names. So that means we are selling some names that we hate to sell, but we have highly weighted positions in them. But there's so many. I think there's so many interesting names in small to mid growth right now that it does make sense to divide up the portfolio and expand the total number of names. I wrote one thing down. It's a little bit tongue in cheek, but I was like, why would anyone buy a growth equity here? We were talking about this just the other day. If you get something right, you may not get rewarded, or you get rewarded in the short term, but a couple of days later it's lower than that price. So wait, even if I win, even I get something right here, I got a lower stock price. If I get something wrong, I'm going to get my butt kicked. Why in the world would I buy a small growth equity right now? It doesn't make any sense. So we're training a lot of people not to buy things right now. So why would anyone buy growth equity right now, Elliot?
Well, yeah, and contrarian instincts, but I know exactly what you're talking about, where a good earnings might be rewarded for a day, if that, and it's probably lower by now than it was at the time of report. And bad earnings is getting absolutely walloped. Something like bad earnings with rising investment, you're getting 20% plus downside. So I do sense that, and I do have seen a couple growth investors talk about energy stocks these days. So, you also get that sort of, you find out who's a momentum trader and who's interested in like analyzing the true intrinsic value of a business.
But you didn't answer my question. Why would anyone buy a growth equity here, Elliot?
Right. I mean, I don't know how to answer your question as best as possible, but I'll quote Buffett, right? Growth and value are tied at the hip. So as long as you could justify the value, you're going to step in, but you are being conditioned right now. I mean, I've heard a lot of people say, I had a conversation last night with a friend about a stock that I think is way too cheap right now. And he's like, I love it. I'm really interested in it. I don't think I could step in front of this momentum right now. And
I have an answer.
Yeah, go for it.
Why would anyone buy a growth equity right now in this market? Because some of these companies are outstanding, and they offer the opportunity for significant long-term appreciation. Just like how, back early in 2000s when I was kind of messing around with Netflix, Expedia, like absolute home runs. Some of these companies, not all of them, some of these companies are going to be huge winners from here, and you're paying a lot less than you were a short time ago, and many of them are continuing to grow. So the valuation is really dramatically lowered in a relatively short period of time. Two, because no one really knows where the bottom is. If you're trying to guess exactly where the bottom is, you stand a very good chance of missing out on the eventual upside. That's why you would step in front of this train. That's why. That doesn't mean you won't lose money tomorrow, but that's why certain people are doing it. That's why we're doing some of it, doing more of it, because there's some pretty big prizes out there right now. And you want to get interested in these companies, when there's blood on the street. People were enamored with growth a year ago, absolutely enamored, and 2 years ago. And here we are, finally, some real pain, some real fear, uncertainty, and doubt. And yeah, there's a certain part of the population that won't step in front of these names, have been trained not to. They're thinking about energy or worried about macro, all these things. Yeah, all these things are present. They may go down more, but you're going to find real bargains when there's fear like this. I have my cash. I'm sitting here with my cash. My cash is very, very valuable right now, and I feel very safe with it. I have some cash, not a lot in the portfolio. And there's all these people that are waving those certificates at me, trying to get me to buy them, trying to get you and I to look at them. And they have to offer us some pretty wild discounts to get us to part with our cash. There's a lot of these companies out there. There's a lot of supply of these companies, a tremendous amount. It's not going to last forever. Mark my words. I don't know how long it takes, but these shares are going to get sopped up one way or the other. Now, again, not every SPAC is going to get a bid from a private equity firm or someone else, but a lot of really good companies here have just been murdered, and it's the time you ought to be looking at them. Is when no one really wants to own them, and the fear is high. And look, it's been painful to get down here. I have to acknowledge that it's been a challenging, tough period for a lot of growth managers. We're included in that. But if you assess things, without emotion, where we stand today, I just think there's a tremendous amount of bargains out there. Companies that are going to do some great things, and you can get them for way less than you could, a short time ago.
Well, I think that's a damn good answer. And it's interesting to think about how we've all been told buy low, sell high from the first day we got interested in stocks. And we all know and internalize the idea that behaviorally it's much harder to do than, the saying suggests. And here we are with the opportunity that many people would have wanted. And you do see a lot of people running from it, talking scared, feeling terrible. Part of it is when, like you acknowledged, we're all taking some lumps along the way. It's a little harder to build the temerity to go out and just get it. But it's, exactly one of the fundamental rules of this all is that the opportunity set has better forward returns from here than it did from up there. And there's no way around that.
Yeah, 100%. It's a vicious cycle right now, for sure. But it won't last forever. It didn't this time. And some of the companies are going to get with the times, and they're going to start doing smart things, and they're going to push back and turn the tide against this absolute decimation in growth equity prices. So it's been brutal. It's about as brutal of a period as I've been through. And we don't own all growth stocks. We have some value names in it, and we've certainly gotten some things wrong, over the past 12 months. But the opportunity set is as high as I've seen it, I think, since 2000, 2003, and that's a long stretch. There's certainly been a lot of opportunities in between, but it's about as high as it's been for a while, and this will eventually create, a tailwind under small and mid growth again, and absolute reversal of fund flows, and all these cycles will start up again. They always repeat themselves. I guess I wish I was better at timing them and knowing how to take full advantage of it. I'm really just I'm a stock picker and portfolio manager. That's it.
Well, one interesting wrinkle for me also, when you talk about some of these stock prices being down so much, is if you have a company that is actually buying back its own stock, you kind of like that the price has come down. I mean, there are a few companies, let's say Twitter, Tencent, Music Entertainment, maybe Facebook, that are big buyers of their own stock. And as a shareholder, you want them to go through a period like this where they can pick up, as much as 50% or 100% more shares for the same amount of money.
Yeah, that's right. Look, Warren Buffett says a lot of these things very, very well. Per share value, it's more important than the overall value. So, certainly accretive share repurchases can make sense. Look, I would say growth companies in general probably are somewhat biased against returning capital because they're all about raising capital, for most of their existence. But seasons change. Things change. The season has changed here. So, could we have more tech companies kind of not buying shares back to offset dilution, but to be shrinking share count at accretive prices? All that really means is that a couple of years from now, when the share price recovers, you're at a higher price than you would have been otherwise. I don't know. Like it's pretty simple. Like if you're buying it back at less than intrinsic value, strategic value, book value, but some accretive, value, you're rewarded for that in the out years. And I do think, a lot of times there's a bias against doing that, in growth companies, and M&A is and adding more skill sets, new skill sets, and different kinds of muscle is more interesting. But I think a really good team is, a buyback is a tool. It's a tool, and I would tend to want to use and think about all the tools in my toolbox to enhance value, all of them. So get on board with that, including growth companies.
And then, from the manager's perspective, right? So I asked you about diversification, but, how do you think about turnover and velocity of ideas in a time like this? Like, how do you create opportunities or look for opportunities to recycle capital too?
It's really interesting. So just prior, since we knew I was going to do the podcast, I kind of looked back at my portfolio, in 1998, kind of through 1998 through 2004. And I did have more positions on, and I had only one analyst early on, I had 0 analysts supporting me. I was the analyst and PM, and then I kind of had one that was helping me. The amount of names was just funny. Like I had 25 to 30 names, and that's a lot of names to kind of be informed on. I think part of that really was that there was more overt cheapness, things that looked interesting. It was easier. You didn't have to build a full model and dive into things and have 50 calls with the management team. Things were cheap, and you had to act fast, and you could kind of pencil it out, relatively quickly. So I had more total names in the portfolio. And then, look, we're long-term oriented, as I think you are, Elliot. And that is what I'm comfortable with. At the same time, who's not looking to put some points up on the board with a management team that is doing things in the near term that's helpful? So I also had more turnover in that portfolio back then. I had way more M&A than I have now. We had tons of names get taken out all the time, and then you would just recycle that cash or those securities right back into the next thing. So I had more turnover in that period and more names than I've kind of had in ensuing periods. And I kind of think we're getting back to that. So that it's an interesting topic I sort of touched on there a little bit, which is, long-term investing, 100% makes sense, great. But I do think that looking for opportunities where there's some acceleration of that same value, or the possibility of something better in the near term, or things getting better, or a buyback to put a floor underneath it, like those things become, frankly, more attractive in this market when things are just going down and down and down and down. And I recalled, I remember I said this back in like 2001 or something like that to my analyst, and it's just stuck around in my head, and I remembered it, which is when we were looking around for all these different names, we're like, doubles were a dime a dozen. Like this thing could double in 2 to 3 years. Doubles everywhere. So then I just remember telling the guy, his name was Ryan, we got to start looking for triples. Let's forget the doubles. There's too many doubles. Where are the triples? Or let's look for the doubles with a catalyst. And, your ability to get pickier and to demand more of these companies, who want good long-term shareholders, want thoughtful shareholders, you could ask for more from them. So that was an interesting dynamic that I got reminded about, in preparing a bit for speaking with you two today, that your output as a portfolio manager may kind of look different in this period than it has more recently, and I think that's perfectly valued. It does not mean that you're no longer a long-term oriented shareholder, but you get to be pretty discerning here, and you might be more attracted to teams that are open and honest with the shareholders and trying to improve the situation, versus other teams that are like, well, here's our game plan, you guys just take a back seat, we got it from here. I'm like, your shares are down, 50%, right? People are putting negative value on this money-losing business. So, don't, again, it's the same message. Can't ignore that stuff. Mr. Management Team, Mr. CEO, Mrs. CEO.
Yeah, that's so interesting. It's something I've been thinking about a lot in general. I feel like the environment has moved so quickly since the COVID crash. I think everything, like, we've had several cycles play out within a very short span of time. And I'm long-term oriented, as you said. I've historically kept my turnover very low, less than 20%, just about every year I've been doing this, except for 2020, and decently lower than 20% in a bunch of the years. And I feel like that had led me, a predisposition and inaction will always be the case, but there's certain environments where when things move faster, that is what you should be thinking about. If a couple of years of returns get pulled forward quite quickly, you should be thinking about doing something a little different.
Yeah, let me tell you one little quick story. It's funny. It occurred to me just now. Small caps were decimated, in that 2001, 2002 period, both growth and value. And I always kind of wanted to be switch hitter, growth and value. So I got into the growth companies at that period. I've kind of talked about that or tweeted about that from time to time. So I grew up a value investor, bought growth, and kind of been growth and value since. Okay. So there's this one company. It was in New Jersey. It looked really cheap, high return business, great balance sheet. It was a cigar distributor. It's still around today. It's called 1-800-JR Cigar. And it was a great high return business that was growing. There was a cigar boom and then bust, but this guy was the biggest buyer of cigars in the world. And so he squeezed everyone out. So he managed to have earnings growth, even in this period of after cigars went through this little mini boom and then kind of bust. And and it was trading at some ungodly low multiple. It was just crazy. And they had a great balance sheet and were generating cash. So I visited them, got to learn the business. And it was a very nice business. So they were a wholesaler, they were a retailer, they sold online. That was the internet was just starting back then. And he had a great business. And he was a nice person and a smart CEO. And so I went in there, I met with him. At the end of the meeting, I was like, his name was Lou Rothman. Lou, I'm buying your shares. They're dirt cheap. You went public. I think they went public with Merrill Lynch, and I think they were below IPO price. I'm like, you got all this cash. You should buy back stock. Just buy back all the stock you can and take it private. And he's like, yeah, okay, interesting, blah, blah, blah. Well, I walked out of that meeting. They announced a buyback, not long thereafter. They were buying back, all the stock they could. And then they went private. And I remember, after the deal was announced, I talked to him. And he's like, do you know after you came into that meeting? Like, we were like, yeah, that's not a bad idea. Why don't we do that? And, it was just a friendly, regular conversation. We were buying it the whole time. We got a very good return on our investment. We got a premium at the end. He still paid he got a good deal. He sold to someone else a couple of years later after it went private. He had a good deal. And it was just, it was kind of a funny little story because, I think these kinds of opportunities are opening up again. We have one company in the portfolio that will go unnamed right now that needs to sell some assets real fast. And the stock's gotten so depressed that they just sell one asset, even for a depressed price. It's going to make all the difference in the world in the valuation of this company. And I'm not going to go into which company that is. But it's just a funny story that this reminded me of. I went in there, had a reasonable conversation. We kind of liked each other. I said, why don't you do this? He did it, and everyone won. And I don't know, like interacting with your companies, talking to them, guiding them through this, and you made some comment before about, look, do I think if you're Carl Icahn, you're going to get a call back from PayPal pretty quickly. If you're someone else and you're calling out a larger company, that you maybe get IR if you're lucky. But I've always felt, that the quality of one's ideas and work, could magnify the size of the holdings, and that's certainly kind of, I think, been true of us. We've tended to punch above our weight, influence wise. So I would say, not to think about the percentage of the shares that one owns. I would think about, is your idea or suggestion a very good one? Does it deserve to be aired to the senior team and potentially the board? And have we written boards letters, thoughtful letters? Yeah, we have. So I think if you spot something, and there's a way for improvement, and well thought out. If you're complaining on Twitter, tweeting at a CEO that they should be, doing this or that, buying some stock back or some very specific thing, that's just noise to a management team. But if you have really good suggestions in ways to improve the competitive positioning of the company, or a blockbuster merger that no one kind of really thought of or considered, take those things to the team. And if they ignore you, take them to the board. You never know what could happen. I walked in that little company in New Jersey, and 18 months later, we made 50% on our money and got like a 20% premium on the shares we bought the day before the deal. So that's I think we're in that environment. There's no sacred cows here, and if you got a good idea, you take it to the team, you take it to the board, and you get on it. You get on it.
Right. It's interesting. Like, management teams absolutely pay attention to their stock price. I remember distinctly listening to a CEO talk during an earnings call, and when their stock was dropping, you heard his tone change. Like, he was clearly watching the ticker as he was listening. Not necessarily a great feature for a CEO, but all these people pay attention. I spoke to a former at a company whose stock is quite volatile, and she was pretty clear about how the CFO would have to tell people, you're never as good as your stock is on a good day, nor as bad on a bad day. But everyone paid attention, and it actually mattered to them. Like, they cared. They knew, because a lot of their own wealth was tied to it. So I think a big part of what you're saying too is, like, if ever we're an environment where they're going to listen, it's right now. If ever we're an environment where they'd be eager to hear ideas that are from, maybe outside of their core competency or core like funnel of ideas, they're more open to it now than ever.
Absolutely, 100%. I've definitely sensed that. Others probably have as well. The rules have changed, and if the players want to be on the court, they can't ignore them. Simple as that.
Yeah, I think one of the clear signs is I do have some teams who hadn't, I'd like you said, you'd get IR, but now you get the CFO, right? And it's a little different. You can tell that people want to listen and are a little more engaged in a different way. And that does create better dynamics just in general for understanding the business better and knowing it better and getting a sense for what moves the people behind it, let alone opening the door to kind of being suggestivist, if you will.
Yeah, the dynamics have changed, but our job hasn't. Our job is to add as much value as we can, and so it's the same. It's the same job as before. The opportunity set is greater, and get out there and make your suggestions. Surprisingly, I've had my own fund for a long time. I think sometimes I get pretty good access because I speak very frankly. I think a lot of times, your typical institutional investor, they might feel one part separated from kind of ownership. Like I'm talking big institutional investors versus someone like me that, I have pretty much all my liquid net worth in the fund. And I kind of think, more like an owner maybe than someone that would have 10 times the position in the same fund. So, I think unvarnished advice and insights without necessarily a fear of like, oh, if I say this, that the team won't want to call me back. I won't hear from them. I won't get access. Like, I'll tell you what your shareholders are thinking that they won't want to say to your face. I'll be polite. I won't be rude, but I'm going to tell you what they're thinking. So by talking to that kind of shareholder, you're going to get a better view and probably better suggestions than the person that's, it's 0.75% of their fund, and they're just in the management fee kind of collection business, and they want access to the management team because they got 8 other investments that they're getting data from to monitor this. That's very different. I do think certain types of shareholders are going to be valued in this marketplace. The new environment for like helping the management teams, get through this environment, intact. And again, they'll, if you don't do a great job there, maybe some barbarian comes, crashing the gates, right?
That seems to be what you can help them preempt in a lot of ways. And it's really interesting to think about. Well, Mario, this has been awesome. Thank you for joining us on this podcast, sharing your wisdom and experience. I just hit 10 years doing this in January. When I had you on last time, it was your anniversary in this business as well. But, for sharing your wisdom, I think it's incredibly valuable for myself, for our audience. Really, really grateful that you joined us here. So thank you.
Thanks for having me. I hope that some of those insights are helpful.
Incredibly so.
All right.
Be well.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.